everyone. Welcome to our show. I'm your host, Caitlin Cormier. There's been a lot of concern in early 2023 about the possibility of a recession in Canada and the US. For those who aren't familiar, a recession is when a country's economic performance declines for at least two consecutive quarters. Some investors worry that persistently high inflation and rising interest rates could cause the economy to falter. That could spell trouble for the North American stock markets if history is any guide. Take the performance of the S&P 500 for instance. The index hit near-term lows during all but 2 of the 15 recessions dating back to the 1920s. It fell nearly 9% on average during the 4 recessions between 1990 and 2020, according to a study by CFRA Research. The S&P 500 has typically fared worst during the first 6 months of a recession. What's more, Schroders found the index fell more than 15% on average during the first 6 months of a recession before rebounding in later months. Some investors may not have the stomach for these ups and downs. Instead, they would prefer a smoother performance for their portfolio no matter the economic environment. Well, the so called all weather portfolio aims to tame those swings, and they could offer investors food for thought as they consider their own asset allocation. So let's take a closer look. Here with us is Dale Roberts, founder of Cut the Crap Investing. Dale, thanks for taking the time to
Thanks
chat.
for having me on. Much appreciated.
So, Dale, tell us, how did you get into blogging about personal finance and DIY investing?
Well, I guess it just started with I've always been so interested in self-directing, if you will. I never really had an advisor. So even through my 27-year career in advertising, where I was a creative director and writer, I spent a good chunk of the day talking about ETFs and stocks. So always from just a great interest and fascination. And I always said, if I could ever find one day that somebody would pay me to talk about it all day, I would. So after that 27-year career, I did move to Tangerine for a few years, for several years as an investment advisor. And then from there, just decided to leave that just so that I could talk about more of a wide range of ETFs, stock portfolios, etc. And yes, just always investing has always just been a passion. I spend too much time reading and writing and researching, and it's just kind of a passion or fascination, and just wanted to share.
That's the dream, being able to be paid for what you want to do, like to talk about something that you want to do and actually get paid for it. So that's pretty amazing. Before we dive into our conversation, I have a trivia question for our audience. According to data from Quebec's financial markets regulator, the S&P/TSX Composite Index has experienced 11 bear markets with declines of more than 20% between 1969 and 2022. How long, on average, has it taken the index to return to its previous high? We'll reveal the answer at the end of our chat, so stay tuned. Okay, let's get into it. So, Dale, first off, you've written that many investors may be making a potentially expensive guess with their portfolio's when it comes to preparing for economic uncertainty. So, what do you mean by that?
Most investors take on way too much risk, right? They're not. When studies will show that, when we get these recessions, we get bear markets, a lot of them get scared and they'll sell at the bottom, right? The behavior is not that good. So traditionally we use bonds, and I like to, the stocks will be growth engines. Let's call the bonds work as shock absorbers to balance things out. So that kind of becomes a two-legged stool, and then it can become a three-legged stool, right? If you have the stocks as growth, and again, typically, bonds are shock absorbers, so that when stocks go down, that the bonds will go up, right? And that typically happens, but of course we found out bonds didn't work, of course, in 2022, is because we had the first bout of real or unexpected inflation that started towards the end of, showing itself at the end of 2021, and then really arriving in 2022. So, and really, I guess it kind of is a guess, because when we don't add inflation protection or dedicated inflation protections, we're thinking that we will stay in a low inflation or disinflationary environment. And typically that's all today's investors know, right? Is from the end of 1981, when the last serious bout of inflation was tamed. All we've known is a couple little ups and downs along the way, but mostly inflation has come down and bond yields have come down as well. So stocks and bonds do really, really well in that environment. So that's really all we know. And again, we're not used to protecting against inflation, and most don't. We moved into a new regime, as we like to call it, new inflationary or new economic environment in 2022. And we don't know if it's going to last another few months or another few years. The interesting thing is that inflation is probably the most unpredictable economic event out there. So I like to be prepared, being a semi-retiree.
Okay, so you talked a little bit about inflation, disinflation, some other things there. So, what are the different economic events that can influence the returns of investors' portfolio?
Within an economic cycle, if you will, we can have various levels. We'll have economic growth or economic decline, if you will. But on the four buckets, if you will, so we could have, and the one that we're all familiar with, or most familiar with, is disinflation. So that's what we've known typically from 1981, where that was the end of the stagflation cycle of the 70s. And really what that is, it just means that the rate of inflation is falling over time. So let's say we had a year where it's 9% inflation, and things moved down to 8, and then moved down to 7. So it's just really a decline in the pace or rate of change of inflation. Again, that's mostly what we've known. There's been a couple of little spikes along the way, but mostly from 1981, it's been down that way, right? So from there, and again, then on the other inverse, we could get deflation, of course, and that really just means it's a rare event. It's probably only happened around 7 or 8% of the time. If we go back the last 150 years, that's really just where prices are falling. So things are getting cheaper along the way. So everything, instead of today, where you go to the grocery store and eggs are $15, it would drop from 2 to 1. So things actually get cheaper. Again, not a good environment though for economic growth. From there, we can also have rising inflation or unexpected inflation. Again, that's where prices are seriously rising. We might be trend for 2%, 3%. Unexpected, that's when we get a spike. Of course, that's what we've experienced in 2022. Again, where inflation's gone from 2, 3, 4, 5. I believe we may have peaked around 9% or so around there. Now things are falling. So that's really just runaway or unexpected inflation. And that again can also come with another period where talk about types of economic growth or stagnation. But again, in the period of the 1970s, they call it stagflation because growth was not robust. So and then from there, then we can get a period of really just benign inflation, if you will, too, right? Where it can be in that typical measure in that 0 to 2% area, where things are just kind of flat. And again, that can typically be okay for stocks and bonds as well. But typically, those are the four buckets of what can happen in the sort of economic cycles.
Okay, and there's a lot to unpack when it comes to the relationship between inflation and financial markets. Those in our audience who'd like to learn more can check out our video series, What Can History Teach You About Market Performance During Economic Uncertainty? It's in the Learning Center on Webroker as well as TD's YouTube page. So, inflation, disinflation, stagflation, and deflation. So, how have different, you talked a little bit, but how have different investment types historically performed in each of those specific economic environments?
Right. So if we start with the disinflationary, which is what most of us know and have lived through, again, that's just a great environment for stocks and bonds, right? Stocks do really well. You'll find different numbers, but typically in the area of historically 9 to 10% annual average returns. Bonds do really well, of course, because as rates are coming down, we get a bit of a premium where the bond prices actually go up. So in that disinflationary, again, just typical, and again, a typical 60-40 balanced portfolio will do really well and has done well because stocks and bonds are both working. If we move to deflation, that's when not a lot of stuff works. Where again, it's typically not a good economic environment for stocks. But again, that's when your cash is going to work really well and your bonds are going to work quite well. If we go up into the other quadrant of unexpected inflation, again, typically not much works there. So again, we have gold, and again in the era of stagflation, it was quite robust where gold actually went up about 9-fold or 10-fold. Commodities followed in the same fashion. And again, historically, the only type of stock that will work with any consistency anyway is energy stocks. Historically did really, really well in inflationary environments, and especially in the stagflation environment of the 70s into the early 80s. And again, we saw that in 2022, right, where again that was really the only sector that performed well. And on that, and REITs do really well too, so or historically did well. So if we look at from the stagflation era and through in any of the little inflationary bouts that we have had since the 1970s, REITs have done their thing as well with very good performance. And then if we go into the sort of the low inflation environment, again, stocks and bonds can do quite well as well in that period. So again, yeah, and it's about 75% of the time we're typically in a disinflationary or in that low inflation environment. So again, that's why we all kind of feel comfortable and know that and build our portfolios for that, not ready for the unexpected inflation of 2022.
So, keeping all that in mind, different types of investments have historically performed better or worse under each economic environment. So, how does an all weather portfolio seek to create a more consistent return across these environments?
We can only have those four buckets, right? That's pretty much it, with various levels of growth or economic decline or stagnation. So again, something is always going to be working. Again, in a severe inflationary environment, doesn't mean you're even going to have positive returns, right? These sometimes just become more about managing the downturns and losing less, let's say, than the traditional stock portfolio or traditional balance portfolio. Again, I think separate those in accumulation where, yeah, we should just invest within your risk tolerance level, but keep putting in monies. Try to ignore all the noise and all the scary stuff that I'm talking about too, in recessions and inverted yield curves. That said, it becomes more important for retirees and those in the retirement risk zone. Typically, within several years of retirement, risk changes. Again, that's when it's more important. More important to, have declines which might be a little bit less along the way, which will help sort of the sustainability of our portfolio dollars in retirement.
So, different types of investments have historically performed better or worse under each economic event. So, with that in mind, how does an all weather portfolio seek to create a more consistent return across these environments?
The best way to frame an all weather is to go back to sort of the genesis of it, if you will, which is the permanent portfolio by Harry Brown, which was really, really simple. So we have our four economic quadrants, and he just typically used one asset type for each. So we had stocks for growth, we had cash again for deflation and recessions and such, had long term bonds, again, which are going to work in market corrections and deflation. And then to cover off inflation or unexpected inflation, we had gold. And so that's sort of the root. And then again, the all weather portfolio will really just take that and expand upon it because we can do a little bit better, right? And I think a good example of that, or potentially do better, which is the inflation basket. Instead of just using gold, which has a bit of a spotty record on inflation, that we can add in commodities which have a more historically a more reliable record, let's say, in fighting inflation, showing up in each event. And then from then, even adding different types of stocks, if you will. And historically, REITs have done well. If we go back to the stagflation area, the 70s and working or moving through, REITs did quite well in stagflation and any other environments that came through. Again, REITs performed as well. So again, we can build on other baskets as well. But I think the inflation basket or quadrant, if you will, is a good place to show that we can take that Harry Brown and just expand or potentially make it a little bit more rich or add more assets, which typically can historically reduce the risk. So typically, yeah, I mean, call it it becomes a four-legged stool, just where we're just going to add, I like to use the word bolt on, where you can take a traditional portfolio and even just bolt on, an inflation protection and just add it on and then rebalance. And I don't know, just for me, I just find a lot of comfort. Folks like to talk about the SWAN, which is the sleep well at night portfolio. And for me, that certainly adds it.
Okay, so that's kind of that permanent portfolio that quarters split up into quarters. But you specifically, how do you augment that sort of structure to make it work better for you?
So again, what I'll do in that inflation bucket, I will use some gold. But these days, at the core is oil and gas stocks, which again had from 2021, I've had a wonderful run. I will also use a basket of commodities. and then there'll be some gold, silver stocks, etc. From there, again, moving into the other quadrants, if you will. In place of bonds, I will use some bond proxies, if you will. So again, those can be higher dividend telcos. And in the US, again, using the defensive assets of healthcare stocks and consumer staple stocks and utilities as well. So use those. So that what it allows me to do is, again, use those to fight either deflation or types of or periods where I might get some market corrections. So I can actually reduce my bond component, if you will. So they're working as bond proxies, if you will, and they're working in a quadrant too to protect. And again, that allows for more greater growth potential over the longer term. So again, I'm just reducing the bond exposure by adding types of stocks.
I love when you say inflation fighters, the first thing that comes to mind is like a superhero team that's assembling to take care of your portfolio. I love those references to fighting and stuff like
Yeah, well,
that.
they're
That's great.
they're they're quite robust, right? Like they really do. They show up, and they show up in spades historically, and they fight hard for you, right? So again, that's the thing with inflation. It's kind of a violent, to use another kind of language, right? It's a violent terrain or scenario, right, where it really causes a lot of disruption, a lot of volatility. Inflation shows up and it hurts, and but those that come up to fight it are actually they're historically quite robust as well. Again, looking back to how oil and gas stocks and gold and commodities, how much they actually did go up in the stagflation era of the 70s. And in the first bout in 2022, they did offer a repeat.
Let's talk about rebalancing. So, what role might rebalancing play in helping an all weather portfolio deliver returns roughly in line with a broader equity market, but with lower volatility along the way?
Right. And again, it's going to be in different periods. It will be different, that you won't necessarily always get, track with the market, if you will. But again, in some, it is actually possible. But again, rebalancing is key, again, because again, you're going to have to take those assets, and everybody rebalances in different fashions. Some will simply just every year, at the end of December, whatever, take a look at the portfolio, bring it back. If you were, 60% stock and 40% bonds, bring it back to that allocation. So sell enough, obviously, the stocks if they've had a good year, and bring it back to 60, bring your bonds to 40. And same thing with commodities, right? That we want to bring it back in. Some will use a rebalancing model. Well, let's say that it goes above 10% more than the asset that's below it. So if you were 60-40 and now you're 70-30, we don't do it by time. We just use it by percentage. So you know what? That's gone up 10% more than the model, if you will. Then I'm going to trim from there and go down. And but again, it really is key to keep it in balance, because again, otherwise you're going to have too much growth, or you're going to have too much defense, and you're going to lag that.
So thank you so much for sharing that approach to building the all-weather portfolio, Dale. Of course, there are so many different ways to protect a portfolio during economic uncertainty. For another perspective, check out the webinar, How I'm Managing My Portfolio During Higher Inflation, with our guest speaker, Mark Seed. It's available in the Learning Center and on YouTube as well. Okay, Dale, while there might be some upsides with the all weather portfolio, no approach is perfect. So, what are some of the potential downsides to consider?
Sure, commodities can suck for a really long time. So when we go into that disinflationary type period, which we had, there are long stretches, right, where commodities don't work because there's no reason for them to work, because prices are actually coming down, right? So obviously, it makes sense that the commodity prices behind it all are actually very stable or declining as well, right? So I think we can reduce that risk somewhat if you have a bucket of, say, gold, REITs, and then energy and the commodities together, and adding in the stocks. At least with the stocks and such, there's the opportunity that there's some dividends coming in, right? That there's something actually working. So if we have gold stocks, at least then some of them can pay some dividends, or material stocks or energy stocks. So you've got that component. Again, it may go away, but it just shows in the period when it works, it really works, right? Typically.
What sort of investor might want to consider an all weather portfolio, in your opinion?
One can use it to manage the risk if they want more of an even flow over the years. But again, some accumulation is probably going to bring down your returns, right? So consider that. Typically, every time we manage risk like that, consider, the greatest growth assets and engines are stocks and REITs, right? And they too will have periods where they don't work. But that's really where the young investor and accumulator wants to sort of focus on, not the risk managers, right? Because those typically they're going to lessen your returns over time somewhat, especially if you over allocate to them. Again, that doesn't discount always invest within your risk tolerance level. If you need to be 50% stocks and 50% bonds because you have a low risk tolerance level, go for it. But for those who have a higher risk tolerance level, these models, again, they're typically in some areas they can reduce, right? So,
What are some considerations you feel investors should keep in mind when maintaining and building an all-weather portfolio?
yeah, again, just make sure that they understand what they're doing and why, and build it. Anytime you build a portfolio, like understand you need to use individual stocks. Can you buy enough of them in a low fee manner? Do you need to use ETFs? Are there mutual funds if they're low fee enough? Build those buckets. Pay attention to taxation, right? So every time we build a portfolio, there's tax events that happen. Um, know what goes where when we talk about, should I build my RSP versus my tax free versus my non-registered. um, add US and international assets or US dollar assets if you can, but again, understand the tax implications that, we don't put those in the Canadian dollar accounts because we're going to lose on currency conversion. So really it's pay attention to taxes, what goes where, and always this risk tolerance level, right? That again, back to the core, which I've always been about recognizing that most people they take on too much risk. So even if you're young, you don't know your risk tolerance level because you've never been hit, right? Mike Tyson has a famous quote, which you probably stole, which is everybody has a plan. It goes until I punch him in the face, right? And that's the stock market coming along. If you've never been hit, you don't know what it feels like. And the only way to experience it is to know it is to experience it and go through it, right? I think it's always, you don't want to make a mistake on the other side where you go, whole hog on equities and you don't know. And in your first experience, I've talked to a lot of clients like this too, where, the first experience is a bad one and they're scared away for good, right? Then they're off into cash and lower performing assets. So I think you can start, learn your risk tolerance level from there and build.
Thanks for sharing these considerations, Dale. Now, an investor needs to maintain their specific asset allocation mix when using an all weather portfolio, and that can be a lot to manage depending on its complexity. So, I want to take a brief pause in our conversation to show our viewers how WebBroker can help them monitor their asset mix and keep their portfolios in balance. Okay, so one great tool that we have to help with building your portfolio and kind of maintaining the proper allocation of different investments is our asset allocation tool. So here I'm under accounts, account details, and I'm going to click on asset allocation. So this screen has a ton of information in one place, and it really helps you to confirm that you have your investments diversified as per kind of what you're trying to do, your investment strategy. So here we can see some balances, our cash balance, the investments that we have. We then have a little pie chart here that's actually breaking into a visual what our diversification in the portfolio looks like. So for this example, we've got majority in Canadian equities, a little bit in US equities, some Canadian fixed income, some global fixed income, as well as cash and cash equivalent. So there's kind of a mix of all of those things together within the portfolio. And again, it is visually represented over here on the left. As we scroll down, we can see here you own multi-asset class funds. Therefore, they could be showing up under more than one category. So that just tells you that if you have an ETF or a mutual fund that actually has multiple categories within that one fund, you'll see it show up in multiple different spaces within this portfolio. So down here, we have the breakdowns of all those categories, and this is where we can actually see which investments fall into which category. So I just opened this up here. It's showing me a couple different investments on the left, the number of shares, market value, book cost, gain and loss. And finally, on the far right-hand side, we can actually see what percentage each one of these different investments is of our entire portfolio, or I should say the account that we're currently looking at. So, the great thing about this tool, as I said, it does the same for all of these categories here. And the great way that you can use this with this all weather type of portfolio is one of the key things is making sure that you're maintaining that proper allocation as far as making sure you have the specific amount in each area. And as things go out of balance, that you can kind of bring them back into order. This is giving you a very quick and easy snapshot of where your portfolio is right now. So you can use that to help make sure that you're rebalancing the portfolio and staying in line with what your strategy is. All right, Dale, we're going to have to wrap our discussion there. Thanks for explaining how an all weather portfolio works and your personal approach to building one. I'm sure our audience has a lot to think about as they prepare their portfolios for whatever's in store for the economy. Now, before we go, let's answer our trivia question from earlier. As a refresher, the question was, according to data from Quebec's financial markets regulator, the S&P TSX Composite Index has experienced 11 bear markets with declines of more than 20% between 1969 and 2022. How long on average has it taken the index to return to its previous high? And the answer is it took the S&P TSX Composite Index roughly 2.3 years on average to recover to its previous high after experiencing a decline of more than 20% in the years between 1969 and 2022. While the average drop from prior high to bear market low was 35%, the index averaged a return of 21% in each of the following 4 years. Is this a surprise to you, Dale, or does that sound about right?
Yeah, I have tons of charts on that. I have pages and pages of chart files where anytime I come across a chart, I grab it. So I probably have that one in five different ways. That sounds about right for sure.
Thanks again for joining us, Dale. And for those in our audience, make sure to register for our upcoming live webinars and check out our library of on demand content available in the Learning Center and on our YouTube page. See you all next time.